Welcome, everybody. My name is Stefan Friedrichowski, as always, at 11 o'clock on Thursdays. Yeah, today we have the 22nd of September, and yeah, a warm welcome to the next webinar, Developing Superb Trading Strategies. One remark before, we have had 1 week without the webinar. So I hope everybody got this information that last week there was no webinar. But anyhow, whenever you want to have the recordings, just look, or maybe you make a screenshot of the link shown on my first slide. There's a YouTube channel link, and you can find all the recordings of those webinars on my YouTube channel. Yeah, last week the reason that we have had no webinar was simply that I have been on the so-called IB days in Frankfurt, which is a nice convention. Yeah, just 1 week all around trading webinars, and still you can find all the recordings on that web page if you are interested in. And by the way, there's one so-called channel which is in English. So there are some webinars in English as well. You will find it directly. Just press at Google IB Days and you will see all the information of last week. And still you can look to the recordings. At least most of the webinars have been recorded, and so that you can have a look today as well. Yeah, but topics for today. Of course, once again, as always, question and answers last week, or last 2 weeks. There is one question I would like to share with you, everybody, and other topics for today. Yeah, that is a principal question for developing trading strategies. That is, what can I expect from a strategy? Of course, nobody can see the future. There's no question, and nobody has any guarantee about the behavior of a certain strategy in the future. But at least what we would like to know is in what ranges should a working strategy develop, or in what kind of expectations can I have for drawdowns? Is there maybe a corridor we can calculate, that we can say within that corridor everything is okay, outside of that corridor we have problems? And yeah, that kind of questions is relevant for all strategies, and I want to introduce 2 kind of concepts in order to get an answer of to that question. The main is the latter one, the so-called bootstrapping. That is a methodology from statistics we can use in order to get a feeling about our expectations and that corridor, to build such a corridor for a strategy. And the other one is simply a question, or I think I introduced that name already, risk of ruin, when we talk about analyzing strategies via the web page FX Blue, because there is a number so-called risk of ruin as well, and that is, yeah, a nice number, and I will show you one way to calculate that number. There are other ways, but for me a little bit more complicated. The third topic for today is something I want to introduce today first, and we will have a look over the next couple of weeks into that topic as well. And that is something I called the predictive power of an indicator. Predictive power means here that we use indicators maybe for normal trading or for whatever reason. But always we have the question, is there something in that indicator yeah, which helps us to see a little bit into the future. And because that should be an ideal indicator, should exactly tell us about the price maybe in 2 hours. That would be nice. That would be a trader's dream to have such an indicator. But what we at least can try, we can look to the history and we can use some indicators, and we can try to answer the question whether that indicator has any at all predictive power. And that is I think a nice concept for developing strategies as well, because then we can identify maybe good and bad indicators and only use, of course, the good ones. And something new I want to introduce within that webinar as well, that is to have always 2 strategies which are ongoing running, that I have a short review on how it looks, the bad and the good, and so on. So that is the 4th topic, and we will find that topic now every week on my agenda. But let's start with the topics. The question was exactly how to calculate risk of ruin. Therefore, I can skip the question because I don't want to answer it, because it would simply is the topic of next chapter. So therefore, I can switch immediately to the next one. So in principle, we have the question, what can I expect from a strategy? When we do trading like I do, that means that I have always, to every strategy, I have a history. Sometimes you can simply call it back testing history, or whatever I have done in order to derive my strategy. I have a history, and out of that history, I can simply get, for example, those 3 numbers we identified in previous webinars to be good key figures for a trading strategy, in order to describe just what comes out of that strategy. And the 3 key figures, or it's more a tuple of those 3 numbers, that is the win rate, the average win, and the average loss. Those 3 numbers can describe statistically any equity curve which, for example, has been derived from a certain strategy. But now, knowing those 3 numbers, and I will do it finally with an example, we have developed already one strategy for the DAX. You may remember we have had a strategy simply operating with a simple EMA, and then 2 alternatives. One was with a percentage stop loss and take profit, and the other one was based on a multiplier to an ATR indicator. I will use the first one because there we have more trades. That means we have more statistics. So we know, for example, out of that strategy, the win rate, the average win, and the average loss. And knowing those numbers, we can exactly derive something I call a corridor. And exactly that is what I want to introduce here. That kind of corridor for what is potential possible with that strategy. And the other question is simply, can we derive something like the risk of ruin of a strategy? So for a given account size and a given risk per trade, then it's possible to calculate a percentage value of risk of ruin. That means if that value would be, for example, 10%, that would mean if you start 100 times that strategy, statistically, then in 10 times your account has been ruined. So that is what means 10% risk of ruin. But let's see to the math exactly. The methodology I will use here is what is called bootstrapping. I assume that simply translating that word even may be misleading. I don't know exactly because it's a strange word. But what does that methodology mean? It simply means a resampling of a given set of results. And if you are interested into that a little bit more, you can find it on Wikipedia as well. There's an article about bootstrapping statistics, and you will find some additional information about that methodology as well. In principle, that methodology works like you have a certain result, let's call it a test sampling or random sample, and then what you do is simply a replacement. That would mean, for example, if we go to that strategy which we have already introduced, the DEX strategy, that has a certain list of traits, and taking that methodology bootstrapping exactly would only mean that we take those 984 traits and the trait results and simply rearrange them just by random. And then we get new equity lines. That is the exactly meaning of the methodology bootstrapping. In the following, I will use only the concept, and the concept means that I first look for the three key figures of that strategy, by the way, which is quite interesting, that we have a win rate only of 17.3% and an average profit of 7.5 and average loss minus 1.1. All the latter one are in the unit of R, means the risk of a trade. One remark, you may not remember exactly why is the average loss a little bit lower than -1, so to speak higher, and not -1, because that has been the original risk for a trade. The answer is simply that we that whenever a gap is coming overnight, it may be, and it will be, that the trade finally ends not at -1 R. There are trades which have a bigger minus simply because of gaps, and therefore the average loss is lower than -1, mathematically speaking, or simply speaking, it's higher than -1. So we know those three numbers, and what we will do, we not rearrange the given list of traits, we simply recalculate everything and go to equity lines which are generated out of those three numbers. You remember we have a simple Excel sheet for doing such a job, and that was this nice Excel sheet where we have a win rate, and in this case it was 17.3%, and we have a win rate, an average win of 7.5 and an average loss of -1.1. And only because to have euro numbers here, I multiply every result with 10 euros or whatever risk you do personally. And of course, we see a very nice equity line, which is a little bit typical for that strategy. Typical means it does not look exactly like the equity line we have had. Oh, sorry, wrong sheet. from our strategy. I move a little bit, or I de-zoom here a little bit. So the red curve is the equity line of our strategy. Of course, it goes up, and if we do it just randomly with our 3 key figures, we get, once again, wrong sheet, then we get, for example, this one. Just by pressing F9, I get another one. Because it's simple rearrangement, or in this case, not a real rearrangement, it is simply random. And you realize already just by pressing once again F9 in the Excel sheet that we get totally different results. You may see now we end up at 6,000 euros, and another result may be this one here. Once again, about 6,000 euros, and so on and so on. But you may remember there was already one picture with a quite bad result, or not bad, but at least something totally different. And what we now, this for example, this goes only up to 3,000 euros. And what we can use, and that is the methodology of bootstrapping, is we can do it simultaneously. So I have another Excel sheet, and what you see here is simply the same, but there are already 100 equity lines within that graph. It looks a little bit funny, I know, and we don't want to follow every single line. Therefore, I still use this colorful picture here, and I have the same values for win rate, average win, and average loss. But you see there's a big range of potential results out of that strategy simply applying statistics. And there's a huge range. All the unit here is risk, so R, and we see results after 1,000 trades, and 1,000 trades was about the statistics of the strategy as well, that even after 1,000 trades, we have a range between a plus of 150 maybe and 600. So we have a huge range of potential outcomes of the same strategy simply by applying statistics. And it looks always more similar now. When I press F9 once again, I get new results. But in principle, this picture now looks similar to the previous one. So we don't have this individuality of a single equity line within the graph. We see already something, what I would like to call a corridor for a certain strategy. It may be a little bit disappointing that we have a good strategy and still there is a probability that we don't have that good result after 1,000 trades. Now I want to look here a little bit more from a statistical point, and a statistical point simply means I can calculate the mean deviation or the standard deviation. Is that just only for that you see what I have done here, and I will enlarge a little bit. What I have simply done is I have averaged all the 100 equity lines and build up the average itself and the standard deviation of all those numbers. And then let's go back to the pictures here, and let's start with the lower one here. This one with a blue line. This is simply the standard deviation of all trade results. And you see this goes up and up and up in average. And by the way, the formula behind is simply a square root behavior from a mathematical point of view. What I have done finally here within the picture above, I took the average and then I added, oh, that's wrong, and I added 1 times standard deviation, 2 times standard deviation, and 3 times standard deviation. So you see the picture now, the blue line is the average line of those 100 strategies or 100 random selections, and in red we have the average plus and minus 1 standard deviation, in yellow 2 standard deviation, and 3 standard deviation in green. I put in the sheet already the numbers for those so-called sigma values, and from a pure statistical point of view, what does it mean? So there's a probability of 68% that a result will be within 1 standard deviation. So that means 68% of all equity lines, which are in this color picture here, 68% should be and will be within the range of the 2 red curves. 95% within the range of the yellow lines, and 99.6% should be and will be between those 2 green lines. What you take personally now as an expectation depends on you. How sure you want to be. So then you take different multipliers of sigma, and you have a corridor like this one here. So my personal favorite would be 2 sigma in this case. So I have 95%, and still I have a huge corridor for the outcome of my strategy from a statistical point of view. By the way, those numbers, once again, I refer to Wikipedia, standard deviation, and then you get exactly those numbers here. Let me enlarge it here. Then you get, for example, those numbers like 68, 95, 99.7 rule here, and you can look a little bit more what does it mean to calculate standard deviation, for example. So that is a nice concept to get a feeling about expectations of a strategy, simply based on those 3 numbers: win rate, average win, and average loss. And now you are able to establish something I call an expectation corridor, and that would be now within those 2 yellow lines, within based on those kind of calculations. So that's a nice concept in order to know what might happen in the future with a certain strategy. Still, I have to emphasize that and to repeat it. I have absolutely no guarantee about any future, but at least what I know now is, just from the point of statistics, in 95% of all cases, it should run between those 2 yellow lines. So that is good to know, because now I can go, for example, after developing a strategy and going live with that strategy, I know what might happen with the future. Another concept is the question of risk of ruin. That is quite simple, because we have it all more or less already within that graph, but I will switch to another Excel sheet as well here. In this case, I started all the equity lines at 0. Of course, you cannot trade with an account with €0. But now what I simply have to do is I have to add an offset here and ask myself, how often do I go through the zero line? And let's do it here, because that is simply already more or less the concept of risk of ruin. In this case, I still stick to the R values, so no euro numbers. It's now I have introduced something like a start equity, in this case simply 20. So more just think about regular trading. You have something starting with 20. You know your average loss is minus 1.1. So it means about 18 trades. If you would start with that account, you can afford, not looking to margin, but you can afford from the start 18 trades, loser trades, and then your account would be exactly at zero. Okay, and I have not talked about margin as well, but that would be your starting position. And now what I know, simply once again going for those kind of numbers here from the DEX strategy, win rate of 17.3% and that average loss and average win in this case, then yeah, I get, for example, this numbers. And now what I have simply done is I have asked within the Excel sheet, let's go to the right, I simply have asked how often in all those cells here, whenever there's a minus in my equity line, then it pops up with a 1, for example, in this case here. And finally, I only ask whether the sum is above 0. Then I get a color line here with a red 1, and that tells me this certain equity line, the equity line 2, has hit the 0 account level. And then I add up all those 0 values, or those ones, and I get a risk of ruin. And in this case, it would be 10%. There is still some uncertainty within that number, so I would have to recalculate it sometimes. So in this case, 23% of all equity lines have hit the 0. But on the other hand, if I, for example, increase my equity, my starting equity, to 50, then of course my risk of ruin will go down, simply because I have a better starting value. That's all. The other way to get my strategy once again into the risk of ruin is simply by lowering the average win, for example. Then I get a new picture now with 16% risk of ruin, even with a start equity of 50 euro. And still you can translate everything here. If you want to go to real euro values, then simply you have to multiply, for example, if you want to risk per trade 20 euros, then your start equity in this case would be exactly 1,000 euro. Still, you have to ask or to answer the question, can I trade the certain strategy exactly with a risk of, for example, 20 euros, taking into account that you have a stop loss value and you want to calculate your position size for a certain trade, and sometimes If those numbers are too low, then yeah, it's not possible to follow your risk management with, for in this case, what I mentioned was 20 euros per trade. So just to be careful that you have both things in mind, your risk of ruin and that the strategy is, let's call it, tradable, so that you really can manage your risk. So that's a quite interesting concept, or both concepts, this bootstrapping, because we now have two new informations about a certain strategy. One is the number risk of ruin we can calculate, and of course this depends on the strategy itself and on the equity. Of course, it takes a longer time if you have not that good strategy and you have a big account. It may take a long time to get the ruin, but you can play around with those numbers in order to know what account size should be applicable for your certain strategy. And the other one was simply that we know the expectation value of a strategy, and we get something like a corridor in order to help our mindset. What can we expect from a strategy itself? Okay. There was a totally different topic I want to go for now, and this other topic is that what I call predictive power. The predictive power of an indicator. And the underlying or the basic question behind is simply me anything, something about the future. For example, you within your chart you have an EMA indicator. And of course, everybody knows the phrase, the trend is your friend. That means if something goes up, it will continue going up, nothing more. And of course, we can use an EMA indicator just in order to get a feeling, do we have a trend, yes or no? Is the trend big or medium or low or negative or whatever? Ideally, such an indicator says, yeah, we can go for a long trade because that indicator tells me we are in a long phase, so with increasing price values of our underlying. And then ideally that would mean that our indicator, yes, it tells us something about the future. Of course, we know we can really predict the future, but it would be already enough if we have a probability advantage, an edge, so to say, that something goes in a preferred direction. And even if an indicator like an EMA or the slope of an EMA is positive, it may be that when we have some certain range or some certain values of that indicator, that we should go for a short trade. That is not the trend is your friend, but even if we know that indicator would tell us something about the future. I always only use, for example, right now the indicator EMA, but you know the list of indicators is huge. And what we always have is a question, does that indicator tell us anything about the future? And of course, you can search in the web, for example, to find some answers about that. And I simply want to the third time within that webinar, I would like to recommend an article, a technical analysis on Wikipedia. And I know that we have the English webinar right now, but I will tell all the Germans this evening as well, reading the English article and not the German, because the English one is much better. And within that article, they discuss a little bit the same question. Not only that question, a lot of other questions, but it is all about, or not all, technical analysis is more than just a few indicators, I know, but at least with the help of some indicators, something is done within technical analysis as well. So let's go back to our basic question. Does an indicator tell us anything about the future? And I will try to give an answer for just one or two examples. And that is based on the methodology which is called correlation. And correlation, I don't know whether you are familiar with that calculation. Correlation means, that's now a little bit misleading to explain one word with the same word, is a measure of how well two series correlate or anti-correlate to each other. And two series simply means two series of data. And following the concept, then the math behind tells you if you find a correlation of 1, you have a perfect correlation. A -1 is also valid. Then it's a perfect anti-correlation, and a 0 or something close to 0 would tell you nope, there is no correlation between those two series. I use a kind of methodology correlation because it's very helpful to have in when we do the next steps. We have values for the indicator, that is the one series of data, and we have values, and I will because I can look to historical data, then I know already the future, and I can compare my indicator with the real future from that point of view, from that time within my history. So since I know the future for a certain time, I can use my value of the indicator exactly of that time and can try whether I find something which correlates to the future of my underlying. And that is what I want to do here. But starting with that, first, let me tell you some more words about correlation, just that you know what we are talking about here when I do all my comparisons with correlation. I have to wait a little bit. My computer is getting slow right now. I hope it will be better in a minute. But it's now I know. The Excel sheet I switched to is 30 megabytes, and I think it will reload as we speak. And before I come to all those nice pictures here, let's start with what is meant with correlation. Still, I have to wait a little bit, and then I can show you the concept. The good thing in principle about correlation is we, from a trading perspective, we could live with both, with correlation or anti-correlation. Both would be nice for us because even if we have something which anti-correlates, it would help us to derive any decisions. Let's assume we have simply some numbers here, that it would be one series of data, And now I have another series of data. Maybe this one here. It's totally random. And if we would plot those two data, and then we have a scatter plot like this one here. And now we have one series on the y-axis and the other one on the x-axis. And we have this plot. That's all. And now the question is there any correlation between our two series? And the answer is quite simple in Excel. What we have is we use the formula correl, and then we have one set of data, and we have a second set of data like this. And in this case, our correlation would be 0.9. And you see already, what does it mean? They are correlated, yes, and you see it already by your eye. There's maybe a straight line going up here, but of course this straight line is not perfect, and especially we can increase, for example, the correlation. If I use for the last number of the second series, maybe at 12, then already correlation jumps to 97% because this straight line is getting better and better and better. I can do the opposite as well. And now you see I only have changed one number, and we get a result which is close to no correlation, which indeed, only those 5 points look a little bit funny. But what I now want to do is I want to reverse it a little bit, and then you realize that so now we get more and more this anti-correlation, which simply means one goes up and the other one goes down. But also that would help us in order to have a feeling about can we use it for trading, yes or no. So that's the concept of correlation. You have two series of data, and then you establish or you calculate the correlation coefficient, and in Excel this is done quite easy. And now just one example. And I will guide you through what I have done here within that Excel sheet. Still I have to wait. But I start already to describe it. In this case, I used Euro US dollar data on an hourly base, so H1 data. And what I have done is I calculated an EMA, and out of that EMA I calculated the slope of that EMA. And in this case I use for slope simply the difference between two lines, and that's all. Additionally, I calculated the ATR only because I want to measure everything with in values of ATR, so that average true range. And what does it mean? ATR we know how to calculate, and then we calculated the EMA value as well, then the slope of the EMA, and last now I took the slope of the EMA divided by the ATR. That means I measure the slope of the EMA in units of the ATR. So describing it with words, that means, okay, there might be a big slope in the EMA, but if the ATR is going high as well, then I don't want to over interpret that bigger slope because everything is changing, so it's only a way of normalization. What I did additionally now, I use the concept of what we introduced with our class trading. This I have done only because I know what I want to do with that concept in the future. In principle, I can answer this question of the predicted power without any classes. I have done here calculation of classes as well, so I give all those values of slope, EMA, in units of ATR. I assign a number between 0 and 9. This is now an integer number because, of course, once again, that has to do with what I want to follow up with that kind of concept. So what does it mean practically? All our slopes now have only values between 0 and 9. That's all. 0 would mean a minus slope, the lowest minus slope we have, and 9 would mean we have a very high slope, and yeah, nothing else. Once again, this is only because what I want to do with that concept in the future. Future, you see already within my Excel sheet that I, from a given point in time, I know the future. And therefore, I can calculate the change for the future. And the same I can do for 2 candles, 3 candles, 4 candles, 8, 6, 16 candles, and so on and so on. Because from that point, this row number 370, I know where the price is in 16 candles. Oops, there. And now we can look to the concept of correlation. You see here in this line that I exactly use the same formula as in this with my 5 numbers or 10 numbers for correlation, so the same formula as well. And what I do here is I correlate, let's mark those values, I correlate my EMA slope, or the class number I calculated out of that EMA slope. I correlate that with the future. The future means the future price in 1 candle, that means future 1, future 2, 2 candles, and so on and so on. And you see, okay, there are only low numbers, but what we see, if we go more to the future, so 256 candles in the future, this number correlation, and that's, by the way, the graph as well, goes up and up and up. I still know we are close to 0, and we can't expect here numbers like a perfect correlation. Of course not. And that is one example for a certain EMA value. And I can now change that EMA value, for example, to 64. And automatically I get a new picture and it looks different. I summarized all those values within one Excel sheet. And now you see the EMA value in powers of 2, that's just for simplification, and the correlation after 2 candles, 8 candles, and so on and so on. Finally, I can get this nice picture. By the way, I built the sum of all the futures as well, the sum after 1 candle, 2 candles, and so on. And that is the blue line here. And for the blue line, we have the right y-axis. And what is astonishing, that for EMA values around 2000, we have a maximum. That means, practically speaking, if I apply an EMA 2000 to my H1 prices, then I have the highest predictive power of my EMA, of my price. Because then the correlation has a maximum within this kind of calculation and investigation. Still, of course, those numbers are small, I know. But we only look for an edge, for a probability advantage. And this may, use the word may by purpose, may give us already a hint that we need high values of EMA in order to have something predictive out of our EMA indicator. Just one example. I hope it goes quick, and you may remember this number 2000 being a good value for EMA following that concept. I have done the same analysis for Euro Japanese yen, and I get a totally different picture. Let me enlarge it. In this case, the correlation is in total lower, and in this case it would be around 20. So the EMA value 20 would be, if at all, the best value with the best predictive power for this concept. So two different underlyings, totally different values with the highest predictive power. Predictive power in general is low, yeah, but we have totally different EMA values, which is, at least for me, quite astonishing. And this is only one indicator. This was the indicator EMA, and with some different numbers in power 2 here. We can use now the complete set of indicators we know, and in most cases, well, a lot of indicators can be described with one single number, or maybe we need two numbers. And what we can do now is we can apply this kind of concept in order to look whether we find something which has some proof of predictive power. Still, there's an additional but, and this additional but is there might be the question, because in this case I did this kind of analysis for the complete set of data, which is 10 years. But it might be that we have to do it versus time. That means don't calculate this correlation over the complete set of data. No, calculate this value maybe for the last 1,000 candles or the last 10,000 candles. So do it time-wise, not for the complete set of data. Do it for a certain history, a certain period of candles, and then answer the question, do I have a predictive power via the concept of correlation? And of course, we can do this for not only for one indicator, we can do it for a complete set of indicators as well. And that is maybe a good idea for building up strategies, because we can use the information of having a good or bad indicator in order to use the right indicators for the right kind of strategies. And that is what I want to establish here with this concept. But of course, we have to do it time dependent and not like shown here with the complete set of data. Last part for today was that I want to look to two strategies which I use not only for a couple of months, although those results I will show are for a couple of months. It's nearly 1.5 years. The total history of those two strategies is longer, but we switched in March the broker from one broker to the other, to Argus, and therefore the history I can show here is starting in March. And those two strategies I want to share with you is one which is called Goldjunge 2. So it's trading with gold, and in this case you see, and the equity line goes down and down and down, and then astonishing, maybe for everybody here, there are no trades anymore, and that has a specific reason. This kind of strategy is an open range breakout strategy for gold, and during the last couple of days or the last 2 months, the volatility of gold is getting lower and lower and lower and lower. Just that you see it here quickly. That is a gold chart H1 based for the last 3 months. And what you can see here, just by looking to the ATR value, is that the volatility goes down and down and down. That means that because we have a range strategy with a minimum range, that for most days we don't hit the level of minimum range, and therefore we don't have any trades right now. For example, today we get no trade as well, and just looking for my information here to the expert advisor who is trading that strategy, you see minimum range 6, and the current range was 3.6, so that's too less, therefore no trade. And within that strategy, there are sub-strategies with different times entering trades, and also for the other time range, minimum range was not achieved. That we have an equity line which goes down, belongs to trading. It's one example, and we went down in total by 18%. Another example of an ongoing strategy is once again a range breakout strategy. In this case, it's a single strategy only on Euro Japanese yen. And you can find all those informations, by the way, on Argonaut platform of Argus FX. And you see, first it goes up, then down, and then in a few steps went back to normal again. So in this case, we have a gain of 13% during the last couple of months. I think it's 5 months right now. So there are two kinds of strategies, both open range breakout strategy, both use an EMA as a filter for the direction. And those strategies are up and running in live accounts at Argus. And hopefully I can get back to my slides here, but it doesn't look so. There we are. In order to get my final slides here, and still I have only there we are. That's good. And That have been the two kind of strategies, with an EMA trend filter, euro, Japanese yen, and this gold strategy has in total 6 sub strategies, 3 only for long trades and 3 for short trades. And we have that minimum range. If we don't have that minimum range, or the actual range, if that is not bigger than the minimum range, we don't enter any trade. And the reason behind is simply, if a range is too small, then the probability that due to random movement that we simply hit the stop loss, which is always on the opposite of that range, then we don't have any trades if the range is not big enough. That's the reason for having a minimum range here. And finally, this has to be compared to the spread of a certain strategy. Yeah. Oh, already 12 o'clock. So once again, thank you for attention. And if you have any questions for strategies in general, any remarks, just send me a feedback, a question to friedrichowski@argusfx.com. And if you want to look through those strategies, for example, then you can go to the Argonaut platform and find them as well there. Yeah, that's for now for me. And hopefully you enjoyed that kind of technique or those methodologies I introduce here. The concept of predictive power and what we can use out of that will be part of the next webinars as well. What we will do there in order to have a more a better concept, then we have to dig into entropy as well. Entropy is something originally from physics, but it's for information technology as well. A very interesting number, this information or entropy. And when we use that as well, then we can get not more predictive power, but we can learn how to figure out, do we have an indicator which has information? Is there anything in with what we can use? And we can better answer this question of predictive power by looking for entropy, but that is one step for next week. So that's for now. And I hope that you have a nice day and a nice weekend, and hopefully we hear each other or listen to each other next week once again. Thank you very much. Bye-bye.